So if you've been paying attention to the financial media at all, you probably read or seen or heard that we are in a bull market, that the stock market is in a bull market. And so that's led to all kinds of questions. If you look at Google Trends this past week, one of the top search terms was, what is a bull market? And then some of the follow-up terms were like, how does this impact me? How does a bull market impact my retirement? So what I want to do in this video is I want to do my best to answer the question, what is a bull market? And you'll have to forgive me if I nerd out just a bit because I really enjoy financial markets and explaining financial markets to clients. One of the reasons I enjoy it is because I think that financial markets often rhyme. There's a lot of great data going back to 1926. There's even some larger data sets that go back to 1802. And we see these rhythms in the market. It wasn't that long ago that I was making another video answering the question, what is a bear market and what typically happens after we enter a bear market? And true to form, this bear market followed almost exactly the pattern of past bear markets. Now, there can always be times that are different, so nothing is guaranteed, but I want to do my best to help answer the question, what is a bull market? And then the second question I want to answer is, what typically happens after we enter a bull market? And then finally, I want to answer the question of, so what? Like, how does this impact my retirement, or how does this impact my life? Should I make any changes based on this information? So let's begin with the most basic question. What is a bull market? A bull market is simply means that we are up 20% in an index. So you have various indexes. The most popular index is the S&P 500, and the S&P 500 is in a bull market. And it simply means that that index is up 20% from its most recent low. So as you see here, I have a chart here that shows when we entered a bear market, and a bear market is 20% decline from the most recent high. So whatever the most recent peak was, a bear market just means we've declined by 20%. A bull market is the inverse. It means we are up 20% from the most recent low. And we just recently crossed that 20% threshold. So that's what a bull market is. There's nothing magical about a bull market. So then the question becomes, what happens when we enter a bull market? And this is where you have some better news, right? The markets typically are up more than they're down. The market is up about 75% of the time. It's down about 25% of the time. And when it's up, it tends to be up much more than it's down. So you'll see here, this chart basically says that once we enter a bull market, good things tend to happen. On average, as a general rule, once we cross over that threshold and we enter into a bull market, the market tends to go up. On average, it's up about 17% 1 year later. I know it's a little bit hard to read these numbers on this chart here. And there have been 3 times over the recent history where we've entered a bull market and it hasn't continued, and we've gone back and revisited the previous lows. 2 of the times were during the tech bubble, and the 1 time was during the great financial crisis. So there's no guarantee that the market will be up, but on average, once we enter a bull market, this bull market continues for a while. Here's another chart that kind of shows how long the bull markets tend to last. The bear markets, as you can see, tend to be much shorter, much shallower than the bull market, which tend to last for a number of years and tend to lead to some significant gains. So that's the good news, is it's rare to enter into a bull market territory to be up 20% from the most recent lows, and for that to not continue and to often be up 17, 18, 19, 20% a year later. In fact, over 90% of the time, that happens. But there are a couple of things that make me a bit nervous about this particular bull market. One of the things is there are a lot of unanswered questions about our economy. Are we going to enter a recession? It's looking increasingly like we might not enter a deep recession. But there's still kind of that question mark out there, and we still haven't seen the full impact of how interest rates are going to impact lending and how interest rates are going to impact future business growth. But the good sign is as we begun to get earnings data from large companies, we've begun to find out that earnings tended to be higher than we expected them to be, which is one of the reasons the market has been moving upwards. But the second thing that has me concerned is that this bull market is not a broad bull market. So for example, in the S&P 500, you have 500 companies. 5 companies make for an overwhelming percentage of the growth that we've seen since the beginning of the year. In fact, if you took out the 5 largest companies or the 5 companies that have driven the growth, the market would be up somewhere around 5%. Now, 5% is still better than nothing or being negative, but it's nowhere near the 20% growth that we've seen from the most recent low. So that's the one thing that makes me a bit concerned, is it seems that much of the growth or much of the good news is being driven by a few companies. On the other hand, by and large, when you see growth in the mega cap companies, the rest of the market often tends to follow. And so it's not necessarily a complete negative, but it's just a little question mark that makes me pause and be a little bit more concerned about what's going to happen next. So far, we've answered two questions. The first is, what is a bull market? And it simply means we're up 20% from the most recent low. Second question is, what typically happens after we enter a bull market? And the answer is good things, on average, happen after we enter a bull market. We tend to continue going up, and we continue going up for a number of years on average. So a few of you may already have begun counting your dollars, imagining how you're going to be spending your money, getting ready to go all in on stocks. But let me just ask you to pause just for a moment, because the next question I want to answer is, what should I do, or how does this impact me? And honestly, my answer in a bull market is the same answer I have in a bear market. You really shouldn't do anything. It's next to impossible to time a market. Markets are a forward-looking mechanism. They're looking into the future. So when we hear good news, markets have typically already priced in that good news. And when we hear bad news, markets have tended to have already priced in that bad news. Now, sometimes they make the prediction wrong, right? They think it's going to be better than it is or worse than it is. So it's not always perfect, but it's really hard to time the market. And so what you find is that we want to sell as the market is collapsing. So when we were hitting our lows in October and we're down 20, 22%, it feels really bad, because if you have $1 million portfolio and you're down $200,000 or $300,000, it feels really bad. And you're like, I want to run to safety. But in reality, that is the exact moment that you should be buying. Warren Buffett always says that when other people are fearful, he's greedy, right? Because when the market is collapsing, that is actually when you want to be most aggressive in buying, or at least based upon historical data. On the flip side, once we start entering into this bull market territory and the market is going up and it feels good and it feels safe, that's when people begin to pile in, but sometimes it's too late. People ask me often, what should be my investment plan? And I tell them, invest during the good days, invest during the bad days, invest when the market is up, invest when the market is down. That's the best plan. That's the best strategy. Now, one of the questions that people are Googling is, how does this impact my retirement? If you need to take out RMDs, today is probably a better time to take them out than when we were at market lows. But so you can talk to your financial advisor about whether you should take your RMDs now or whether you should wait until later. I'm a financial advisor, but I am not your financial advisor, so I'm not going to give you any advice on how you should proceed. But as a general rule, during bull markets, you want to do the same thing as you did during a bear market. You just want to continue staying invested, continue adding to your investments, and don't get over exuberant. Don't go all in. Don't leverage yourself in the same way you wouldn't go all in and leverage yourself during a bear market, but just continue with the same strategy that you had before. So I hope this information was helpful to you. I know it's nothing earth-shattering, but I think it's just helpful to understand that typically when we enter a bull market, we often continue having good days for a significant amount of time afterwards. At the same time, you just want to be a bit cautious and don't do anything silly and go all in or over leverage just because we're hitting a euphoric time, because there are going to be down days. But even if this bull market continues, it's not going to be completely up and to the right. There are going to be dips, and there is a chance that we could go back and revisit prior lows or maybe even undercut prior lows. And if that happens, we're going to do the same thing we're going to do during a bull market. We're just going to stay consistent, stay steady, keep investing, and that's the way you make money in the long run. Here's the one final thing I'll leave you with. One of the biggest mistakes I see people make in the market is that they allow emotions to rule their investing. They get exuberant during greedy times right at the wrong moment, and they get fearful during downturns right at the wrong moment. So you just want to stay on track no matter whether the market is going up or whether the market is going down. If you need the money to live on, if you have some living expenses that need to be covered, you always want to keep some of your money in safety. Don't ever invest money that you're going to need over the next 3, 4, 5 years, because we don't know what the market is going to do. On the other hand, I often see people who are overly cautious, who are way too cautious because they're afraid of the volatility. As I tell my clients, volatility is simply the price of admission. I hope you enjoy this content. If you would, leave a comment below, subscribe, ding that bell. All of those things help the algorithms know that this is content worth watching. And if you have a question or comment, feel free to leave it in the comment section below. And if you want to talk to a financial advisor, I am always more than willing to have a conversation with you. You can just go to foundryfinancial.org and schedule a call.